Hi everyone, it's Jack about another video, and today I'm going to be talking about Bank of America stock. Recently released its second quarter earnings before the market opens today. Results were fantastic, as it has been for most of the big bank stocks which have announced, but I think really Bank of America and JP Morgan are in a class of their own, and I want to talk about today how strong Bank of America's results were, look at their performance, the valuation, its dividend yield, its dividend history, how often it buys back shares and what's been happening to its share count, and whether I think there's a buy, sell or a hold going forward. Here is a very relatively high level summary of those results. Three things I'm looking at here, four things: revenue, net income and therefore earnings per share, and in this case net charge-offs, those being when the bank writes off as a loss an account, normally credit cards in this case, because the economy is getting worse, credit is tightening, a lot of households are put under pressure by rising interest rates, so it's key here to be following the net charge-offs. Unfortunately, they were up significantly, but not significantly enough to be of major worry in my opinion, not even over $1 billion, although up 52% from the year prior, which is to be expected really, judging by the increase in interest rates. Total revenue, $25.2 billion for the quarter. While that is less than the previous quarter, it's still an 11% increase year over year. There's a degree of seasonality in the individual quarters, so I'm not overly concerned about that. Best to compare it year over year, and that's an increase of 11%. Net income up 19% year over year. Again, interest rate rises are going to have a massive effect here. That's a huge tailwind for a bank like this, so no surprise here that net income is really strong. But again, lower quarter over quarter, which I'm not so concerned about. And diluted earnings per share up 21% year over year to nearly 90 cents per share. Another key metric I was looking at is deposit trends, and it looks relatively positive to me. Obviously, with the banking crisis of earlier on this year, the likes of Silicon Valley Bank and First Republic going under essentially because of the runs on the banks, it was key to look at the average deposit trends of all the major banks to see if there's any problems here. That is very much not the case with any of the large banks really. There's still been, since Q2 last year, so in the previous year, there's still around a 10% drop in average deposits, but it's still way up on Q4 2019 numbers, around 46% up in terms of non-interest bearing and 28% up in terms of interest bearing. And compared to the last quarter, a reduction of just 1%, which is essentially, it's meaningless on this sort of value at nearly $2 trillion. Consumer banking, again, slightly down the previous quarter, but not really of anything to be concerned about in my opinion. And global banking was a small increase, but again, these are just essentially counting errors on the sort of numbers we're talking about. Trillions, $500 billion numbers. I don't think this matters so much. I was more looking for a massive drop in deposits, and that just has not been the case. Next, some softer metrics, or more broadly, how this compares with the competition and the rest of the banking industry. And it really is a business leader in terms of consumer banking. Number one in estimated US retail deposits, number one in online banking and mobile banking functionality, number one small business lender, often voted the best bank in North America, often voted the best consumer digital bank in North America. It really has excellent customer satisfaction numbers and has a clear market lead, and is at worst the second biggest player in the consumer banking market, and has absolutely outstanding metrics across the board first. Next thing to look at is clearly the balance sheet. Bank of America has just about as strong of a balance sheet as you are likely to see in a bank. Total assets of $3.123 trillion. That's up very slightly from Q2 2022 and down very slightly from the previous quarter. This lower large numbers, so down 70 billion sounds like an awful lot. It's not really that much on a percentage terms. It's effectively a counting error. Cash and cash equivalents almost doubled to 374 billion year over year. Total deposits, as we've mentioned, was down. Long-term debt up very slightly. Equity up significantly year over year. Common equity ratio at 8.2%. Book value per common share is up significantly from the previous year, over 10%. Now sitting at $32.50, meaning this business is trading below the bank's calculated book value per common share. Common shares outstanding, 7.95 billion. That's down significantly from the 8 billion or 8.04 billion in the previous year. The quality of those assets is also key. Net charge-off ratio is very low at 0.33%, even if that is increasing at a relatively significant rate year over year. Quarter over quarter, there's essentially no change, and while the environment is tough, I'm not worried about a net charge-off ratio in the 0.33% range. Credit card loss rate is about 2.6%. It was 2.21% the previous quarter. This is significantly lower even than the pre-pandemic loss rate of 3.03%. So again, nothing to be too concerned about. Pre-pandemic was kind of a relatively stable period in terms of interest rates, in terms of the economy at the Q4 2019. So compared to now, I think they're doing reasonably well in terms of net charge-offs. And the provision for credit losses more than covers this. They had net charge-offs of $869 million and $1.125 billion in this quarter of provisions to this. So it's more than covered by that, and doesn't really concern me in the slightest, to be honest. This is a bank that has very high asset quality, in my opinion. Before we get into the tremendous amount of cash this business has returned to shareholders, I want to talk about valuation. Currently trades at a price to earnings around 8.8, call at 9, compared to a 5-year average around 12, and the S&P 500, or the index right now, is trading around 21.5 times trailing earnings. That is obviously very, very high for the S&P 500, far above what it would normally trade, which is around 15. This business is trading at a significant discount to the S&P 500, even on a forward earnings basis, which is looking around 8, compared to the 5-year average of 11.6. This is far, far below where it's traditionally valued. Price to cash flow around 8.6 is again far below the 5-year average. This is often skewed by some aberration years, 2021, 2017, but it is at least in line with generally where this business reports, and far, far below the S&P 500 average. And price to book value is really a key metric for banks, in my opinion. Anything less than 1 is typically considered a bargain. This business is trading at 0.93 times book value. I would consider that a bargain. Price a book of up to 1.1, 1.2 I would be willing to pay for this business, because I think it is worth that premium. At 0.93, I think this is, relatively speaking, a steal, and offers an excellent earning yield right now of potentially 11.3%. In addition to being reasonably valued, in my opinion, or far below its fair value, this business also pays an extremely well covered nearly 3% dividend yield, with just a 26% payout ratio that has grew a 5-year compound annual growth rate of 12.89%, which is far above market average, and the dividend has grew consecutively for 9 years. This is not a consistent dividend by any means in terms of growth, but it's very rarely cut. It was cut during the financial crisis, essentially because it had to. That is an aberration, in my opinion, and going forward, I think Bank of America's dividend track record looks very, very strong. Perhaps even more impressively than the dividend yield is how this company has returned cash to shareholders in the form of reduction in the shares outstanding, or share repurchases. From 2013, so 10 years ago, this company had around 11.5 billion shares outstanding, to in the most recent quarter it has just under 8 billion. So that's a 28%, 29% decrease in shares outstanding across 10 years. Absolutely excellent returns. That is why the earnings per share continues to go up, in addition to organic growth. Just fantastic returns to shareholders in addition to the dividend. I would argue in a more tax efficient way and more desirable for me, but of course income investors want that dividend. To summarise, I think this is an absolutely excellent business that is performing outstandingly, that is returning capital to shareholders at a fabulous rate, and has reasonably high tailwinds behind it while interest rates remain high and the economy appears to be doing reasonably well, or better than it has been doing. I think this bank can only go on strength to strength. It's a market leader, it's a sector leader, and I think it is going to continue to do very well. That's why Warren Buffett owns it. That's why it's been an excellent investment over the longer term. Of course, that's just my opinion. You should let me know what your opinion is in the comments down below. I'm not a financial advisor. None of this should be taken as financial advice. Capital is at risk at all times. You should do your own research and due diligence. I encourage you to do so, or contact the registered financial advisor. Let me know what you think in the comments down below. Like and subscribe and enjoy the video. I'll see you again next time.